In today's video, we are doing a deep dive into construction business accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The construction industry, a cornerstone of infrastructure development, is vast, involving major players like Shapoorji Pallonji Group in India. Globally, it contributes significantly to GDP and employment. Understanding this business requires insight into its complexity, from large-scale projects to stakeholder management. Companies like Shapoorji Pallonji thrive on their ability to manage intricate projects, balancing cost, quality, and timelines. Construction companies generate revenue through contracts for infrastructure projects, encompassing residential, commercial, and industrial sectors. Revenue streams include project fees, government contracts, and private investments. Key cost drivers are labor, materials, and equipment. For instance, Shapoorji Pallonji manages costs meticulously to maintain profitability, focusing on efficient project execution. Understanding these financial dynamics is crucial for effective accounting and decision-making. In construction, departments like finance, operations, procurement, and legal play pivotal roles in accounting and project success. Finance ensures budget alignment and cash flow management, while operations oversee project execution. Procurement handles vendor relations and material sourcing, and legal manages compliance and contracts. Shapoorji Pallonji's integration of these departments ensures seamless project delivery, highlighting the interdependence within the organizational structure for accurate accounting and financial reporting. Understanding the workflow in construction is essential. It typically begins with project planning, followed by design, procurement, construction, and project closure. Each step involves coordination among departments. For example, Shapoorji Pallonji's projects start with meticulous planning, ensuring all stakeholders are aligned. This structured flow from planning to closure ensures efficiency and cost-effectiveness, with each department playing a crucial role in maintaining project momentum and financial accuracy. Construction projects involve diverse stakeholders, including clients, vendors, government agencies, banks, and regulators. Each plays a vital role, influencing accounting practices. Clients dictate project scope and payment schedules, while vendors provide materials, impacting inventory management. Government regulations affect compliance costs, and banks offer financing options. For Shapoorji Pallonji, understanding stakeholder dynamics is crucial, ensuring smooth project execution and accurate financial reporting. The construction industry faces unique challenges such as fluctuating working capital cycles, complex contracts, and stringent regulatory requirements. For instance, Shapoorji Pallonji must manage long payment cycles and anticipate regulatory changes. These factors affect financial planning and require adaptive accounting strategies. Understanding these challenges helps accountants provide accurate financial insights, ensuring project sustainability and compliance within the sector's dynamic environment. Construction accounting is unique due to its project-based nature, requiring job costing, revenue recognition, and contract accounting. Unlike generic companies, construction firms like Shapoorji Pallonji manage complex projects with varied timelines and costs. Accurate cost allocation and revenue recognition based on project completion are crucial. This complexity demands specialized accounting practices to ensure financial accuracy and project alignment with contractual obligations. In construction, accounting entries are typically handled by the finance team, triggered by project milestones, vendor invoices, or client payments. For Shapoorji Pallonji, these triggers ensure accurate revenue recognition and expense tracking, aligning with project progress. Understanding when and why entries are made is crucial, as it affects financial reporting and compliance. This meticulous process ensures that financial statements accurately reflect the company's operations and contractual obligations. In this section, we'll explore the end-to-end accounting process in the construction industry. From initial orders to final payment and reconciliation, every step is crucial. Understanding these processes helps in managing finances effectively, ensuring profitability, and maintaining compliance. We'll use a real-world example from Shapoorji Pallonji Group to illustrate each step in detail, emphasizing the importance of accurate documentation and timely execution. The tender process is the first step in securing construction projects. The estimating department prepares project bids based on detailed cost analysis. Accurate tenders are crucial to winning contracts without compromising profitability. Documents like bid proposals and cost sheets are used, and the result is a potential revenue stream. Mistakes here, such as underestimating costs, can lead to financial loss or project delays. Once a tender is approved, it's crucial to finalize contracts, establishing legal terms and project scope. The legal department reviews all terms to ensure compliance with regulations. Contracts and purchase orders formalize agreements, triggering future payment schedules. Errors in contract terms or missing clauses can lead to disputes and financial liabilities. Therefore, attention to detail is essential during contract negotiation and approval. Advance payments help finance initial project costs. The finance department processes these payments based on milestones set in the contract. Documents like advance payment requests and receipts are essential here, as they trigger accounting entries affecting cash flow. Mismanagement of advances can lead to cash shortages and affect project timelines. Ensuring the accuracy of milestone tracking is critical for smooth cash flow management. Receiving goods and services is a critical step in the construction process. The procurement and logistics teams ensure that materials and services meet quality and specification requirements. Goods receipt notes and inspection reports are key documents here, triggering inventory updates and accounting entries. Mistakes like accepting incorrect or substandard items can result in project delays and increased costs, emphasizing the need for stringent quality checks. Managing work in progress is vital in tracking construction project advancement. The project management team regularly updates WIP reports, reflecting the percentage of project completion. These updates inform billing schedules and financial projections. An inaccurate WIP assessment can mislead financial reporting and cash flow management. Underlining the importance of precise tracking and timely updates. Continuous communication between project and finance teams is crucial. Upon project completion, the accounts receivable team prepares invoices based on completed milestones. Accurate invoicing ensures timely payment collection and cash flow stability. Documents like certificates of completion and final invoices are critical. Errors in invoicing can delay payments and affect financial liquidity, highlighting the need for precise documentation and adherence to contractual terms. Effective communication with clients ensures smooth invoice processing. Timely payment collection is crucial for maintaining healthy cash flows. The finance team manages collections, ensuring that payments are received and reconciled against invoices. Bank statements and payment receipts are key documents, ensuring accurate financial reporting. Delays or discrepancies in payments can impact cash flow and financial planning, necessitating effective credit management and follow-up strategies. Reconciliation ensures accuracy in financial statements. The financial period close process compiles all financial activities into comprehensive reports. The accounting department finalizes all entries, ensuring that every transaction is accounted for. Closing procedures include reconciling accounts and preparing financial statements. Mistakes during period close can lead to inaccurate financial reporting and non-compliance issues. Thus, thorough checks and balances are essential. Timely closing is critical for strategic decision-making and regulatory compliance. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is about determining when a company can record income from its contracts. In construction, this is crucial because projects often span months or years, and revenue needs to be recognized as work progresses, not just when a project is completed. Indian Accounting Standard 115 provides guidelines on recognizing revenue based on fulfilling contract terms, focusing on performance obligations, which means you recognize revenue as you complete portions of the project. For example, Shapoorji Pallonji Group recognizes revenue as they achieve milestones in building a skyscraper. This differs from general accounting, where revenue might be recognized at a single point in time, such as upon delivery of goods. In construction, recognizing revenue accurately ensures financial statements reflect true business activity. Inventory valuation assigns a monetary value to unsold goods, crucial for calculating profit margins. In construction, inventory isn't just raw materials. It includes work in progress like partially completed buildings. Indian Accounting Standard 2 necessitates valuing inventory at the lower of cost or net realizable value, ensuring financial statements reflect potential losses. For instance, Shapoorji Pallonji Group assesses the cost of steel and cement, considering price fluctuations and site-specific conditions. Unlike retail, where inventory valuation might be straightforward, construction inventory involves complex assessments of partially completed work and material storage. This specificity ensures financial statements accurately portray the economic conditions of construction projects. Fixed assets are long-term resources used over several years, such as machinery and buildings. In construction, companies invest heavily in machinery like cranes and bulldozers, critical for large projects. Indian Accounting Standard 16 provides guidelines on recognizing these assets, their depreciation, and potential revaluation. Depreciation, the allocation of an asset's cost over its useful life, affects both financial results and tax liabilities. For example, Shapoorji Pallonji Group might choose a straight-line depreciation method for its cranes, spreading the cost evenly over years. Unlike general businesses, construction firms often have extensive and specialized equipment, making precise depreciation critical to financial health. Proper asset management ensures accurate financial reporting and compliance. Lease accounting deals with how companies record and report leased assets, which is significant for balance sheets. Construction companies often lease expensive equipment like excavators to manage cash flow. Indian Accounting Standard 116 mandates that companies recognize leased assets as right-of-use assets and corresponding lease liabilities on their balance sheets. This approach ensures transparency about future financial obligations. For example, Shapoorji Pallonji Group might lease heavy equipment, which shows up as assets and liabilities, affecting their financial ratios. Unlike general industries where leasing might be more occasional, construction often relies on leasing for operational flexibility, making lease accounting pivotal for accurate financial portrayal and strategic planning. Contract accounting focuses on tracking the financial progress of ongoing projects, crucial for industries like construction, where projects can last years. This involves managing costs, revenues, and billing cycles over time. Indian Accounting Standard 11 provides guidelines on recognizing contract-related costs and revenues as work progresses, rather than waiting until completion. This is critical for companies like Shapoorji Pallonji Group, which need to show shareholders accurate financial progress on large projects, such as multi-year infrastructure builds. Work-in-progress reporting allows them to present a realistic picture of their current project statuses. Unlike standard accounting, which might recognize costs and revenues at a single point, contract accounting ensures that construction companies report a continuous and true project financial health. Provisions and contingencies involve setting aside funds to cover future obligations or possible liabilities. This is especially important in construction, where projects face numerous risks, from design changes to legal disputes. Indian Accounting Standard 37 outlines how companies should recognize and measure these provisions, ensuring that financial statements reflect potential financial impacts. For instance, Shapoorji Pallonji Group may set aside funds for potential warranty claims on completed projects. Unlike general industries where provisions might be less frequent, construction projects are inherently riskier, necessitating a more robust approach to managing potential financial impacts. Being prepared financially for unforeseen events is crucial for maintaining project viability and company reputation. Foreign currency transactions involve recording and managing transactions that occur in currencies other than the company's functional currency. In the construction industry, this is crucial because projects often involve international suppliers and cross-border contracts. Indian Accounting Standard 21 provides guidance on how to account for changes in foreign exchange rates, requiring companies to adjust their financial statements to reflect the real economic effects of currency fluctuations. For Shapoorji Pallonji Group, Purchasing materials from overseas suppliers means that exchange rate movements can significantly impact their project costs and financial results. Unlike general domestic-focused businesses, construction firms often deal with multiple currencies, making foreign currency accounting a critical aspect of financial management to ensure accurate and transparent reporting. Cost allocation is the process of assigning production costs to different projects or departments. In construction, this is vital due to the extensive sharing of resources like labor and machinery across multiple projects. Proper cost allocation ensures that each project's profitability is accurately depicted in financial reports. For a company like Shapoorji Pallonji Group, this means meticulously tracking both direct costs, like materials, and indirect costs, such as administrative expenses, to assign them appropriately to each project. Unlike general industries where cost allocation might be straightforward, construction projects often share resources and incur unique costs, making detailed tracking essential. Effective cost allocation provides insights into project performance and helps in making informed business decisions. Deferred revenue represents payments received before services or goods are delivered, a common occurrence in construction due to advanced project payments. Indian Accounting Standard 115 requires these amounts to be recorded as liabilities, not revenue, until the associated performance obligation is fulfilled. This ensures that financial statements do not prematurely reflect earned income. For example, Shapoorji Pallonji Group might receive a substantial upfront payment for a new office complex, which is recorded as deferred revenue until each construction phase is completed. Unlike general accounting, where revenue might be recognized immediately upon receipt of cash, deferred revenue in construction reflects the project's ongoing nature and ensures transparency in financial reporting. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The initial capital investment sets the financial foundation for Shapoorji Pallonji Group, allowing it to start operations. By crediting equity share capital, we acknowledge the owner's contribution as a liability to the company, in exchange for shares. This amount is deposited into the bank, increasing its cash reserves. With these funds, the company can make necessary purchases and cover operational costs. Purchasing materials on credit is a common practice in the construction industry, allowing the company to begin operations without immediate cash outflows. By debiting inventory, we acknowledge the asset's increase, reflecting the materials ready for use in projects. The credit to accounts payable indicates a future obligation to pay suppliers. This arrangement aids cash flow management, crucial for sustaining large-scale construction projects. As construction begins, transferring materials to work in progress, WIP, reflects their usage in project development. This move highlights a shift from inventory, which are stored assets, to WIP, which are active costs in creating the final asset. Accurately tracking these transitions ensures precise project costing and financial forecasting, essential for project management and stakeholder reporting. Labor costs are critical in construction, directly impacting the work in progress account as they represent active project expenses. These costs are paid in cash, reducing the company's cash reserves. Properly recording labor expenses ensures transparency in cost management and aids in evaluating project profitability. Accurate tracking can help in identifying cost overruns early, allowing for timely corrective measures to keep the project within budget. Bank loans are often used to supplement cash flow in capital-intensive industries like construction. The loan boosts the company's cash reserves, allowing for continued project investment and operations. Crediting long-term liabilities acknowledges the obligation to repay the borrowed amount. This financing approach provides crucial liquidity, enabling the company to maintain momentum on projects without immediate reliance on incoming revenue. Revenue recognition at project milestones is standard in construction, reflecting earned income as work progresses. This method aligns with contract terms, allowing the company to match revenue with the costs incurred during the period. By recording accounts receivable, we anticipate future cash inflow from clients, crucial for maintaining liquidity and ensuring that the company's financial statements reflect its operational reality accurately. Receiving client payments is pivotal in maintaining cash flow, enabling the company to settle its liabilities and fund further operations. Debiting the bank account indicates an increase in cash reserves, while crediting accounts receivable reduces outstanding client payments. This transaction confirms the conversion of earned revenue into cash, vital for sustaining business operations, paying down debt, and reinvesting in future projects. Timely payment to suppliers is crucial for maintaining good business relationships and ensuring a steady supply chain. By debiting accounts payable, we reduce the company's outstanding liabilities, demonstrating financial responsibility and integrity. Crediting the bank account reflects the cash outflow necessary to clear these obligations. Effective management of payables is essential for preserving credit terms and securing optimal pricing on future purchases. Interest payments are a critical cost of borrowing, affecting the company's profitability. By debiting interest expense, we acknowledge the cost incurred for utilizing loan funds, impacting the income statement and reducing net profit. Crediting the bank account reflects the cash outflow for this financial obligation. Managing interest payments efficiently is key to minimizing finance costs and optimizing the company's capital structure. Period-end adjustments are crucial for aligning financial records with economic reality, capturing expenses incurred but not yet paid. By debiting expense accounts, we accurately reflect costs affecting the current period's profitability. Crediting accrued liabilities acknowledges future cash outflows, ensuring liabilities are recorded. These adjustments maintain the integrity of financial statements, providing stakeholders with a true picture of the company's financial health and operational performance. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In the construction industry, like for Shapoorji Pallonji Group, current assets are crucial as they reflect the liquidity available to execute projects. Accounts receivable show pending payments from clients, essential for cash flow management. Inventory represents materials on hand, impacting project readiness. Cash and equivalents ensure operational flexibility, while prepaid expenses such as insurance reduce future cash outflows. Accurately managing these elements supports project continuity and financial stability. For Shapoorji Pallonji Group, non-current assets like construction equipment and buildings represent long-term investments critical for project execution. These assets facilitate operational efficiency and project capacity. On the liabilities side, long-term debt finances significant assets, impacting interest expenses and cash flow. Equity reflects the owner's stake and is crucial for assessing financial health and investment potential. Balance sheet management balances growth with financial stability. Revenue generation for a construction firm like Shapoorji Pallonji hinges on contract revenues, reflecting project completions. Direct costs, including materials and labor, are substantial and must be managed efficiently to maintain profitability. Subcontractor costs are also critical, as outsourcing can be strategic for scalability, but can pressure margins if not controlled. Understanding these dynamics helps forecast profitability and assess project viability, crucial for strategic decision-making. In the profit and loss, indirect expenses like administrative costs impact the operational efficiency of a construction firm. EBITDA provides a snapshot of profitability, excluding non-operational expenses, critical for evaluating core performance. Profit before tax is a key indicator of overall financial health before tax obligations. Depreciation accounts for the wear and tear on long-term assets, influencing both tax and profitability measures. Together, these metrics guide financial planning and strategic adjustments. Cash flow management is vital for construction companies like Shapoorji Pallonji. Operating cash flow assesses the cash generated from core activities, crucial for sustaining daily operations. Investing cash flow reflects capital expenditures on assets, influencing long-term growth. Financing cash flow indicates funding activities through debt or equity, affecting liquidity and leverage. Net cash flow provides a comprehensive view of financial health, influencing investment and operational decisions. Key financial ratios provide vital insights into the operational and financial health of construction companies like Shapoorji Pallonji. The current ratio assesses liquidity, crucial for meeting short-term obligations. Gross profit margin evaluates profitability from core activities, indicating pricing and cost management efficiency. Debt-to-equity ratio analyzes financial leverage, balancing risk and growth potential. Return on assets measures asset utilization efficiency, guiding strategic asset investments and operational effectiveness. In this section, we'll explore common errors in construction accounting that can impact financial reporting and operational efficiency. Understanding these errors helps in ensuring accurate financial statements and avoiding potential pitfalls during audits. This is crucial for companies like Shapoorji Pallonji Group, where complex projects and contracts require precise accounting practices to maintain financial integrity and support business decisions. Misclassifying costs can lead to inaccurate financial reporting and misinformed business decisions. For instance, if labor costs are recorded as materials, the profit margins might appear inflated. This error often arises from inadequate training or misinterpretation of account codes. Auditors can detect this by tracing transactions back to source documents and verifying the appropriateness of account classifications. Correct treatment involves reviewing classification guidelines and ensuring all accounting personnel are trained and aware of the correct procedures. Retainage, a common practice in construction, involves withholding a portion of payment until project completion to ensure contractor performance. Often, candidates overlook this in interviews, underestimating its impact on cash flow and financial statements. Failing to account for retainage properly can result in overstated revenues and cash balances. An auditor checks for this by reviewing contract terms and matching them with recorded revenues. Understanding retainage is essential for accurate project accounting and financial health assessment. In the construction industry, where ERP systems handle vast amounts of data, incorrect data entry can significantly impact financial reporting. This error often stems from human mistakes or inadequate training, leading to discrepancies in project costing and billing. To mitigate these risks, companies like Shapoorji Pallonji Group should implement regular training programs and data audits. Auditors can identify such errors by cross-verifying entries with original documents and ensuring that system controls are effectively in place to prevent future occurrences. Cut-off errors in revenue recognition can lead to significant misstatements in financial results, impacting a construction company's perceived performance. Such errors often result from delays in communication or processing, causing revenue to be recorded in the wrong accounting period. For instance, recognizing revenue before a project milestone completion can overstate current period earnings. Auditors can uncover these errors by comparing transaction dates with accounting records. Correcting this requires aligning financial reporting with actual project progress and contract terms. Standard switching errors occur when transitioning accounting frameworks, such as from international financial reporting standards to generally accepted accounting principles, without properly adjusting accounting policies for differences. For construction companies, this may affect revenue recognition and asset valuation, potentially leading to compliance issues and misleading financial reports. For example, differing treatment of joint arrangements can affect consolidation. Auditors examine the consistency of applied standards and verify adjustments. Proper transition requires comprehensive understanding and implementation of the differences between the two standards to ensure financial statement accuracy. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The percentage of completion method recognizes revenue based on the project's progress, crucial in long-term construction contracts like those at Shapoorji Pallonji. It ensures revenue is matched with corresponding costs, preventing profit overstatement. For instance, if 40% of a project is complete, 40% of the total expected revenue is recognized. This method provides a realistic picture of financial health, especially when projects span multiple accounting periods. Retention in construction contracts is a portion of payment withheld until a project is satisfactorily completed, ensuring contractor performance. For accounting, retention is recorded as a current liability until released. For example, if Shapoorji Pallonji withholds 10% of a contractor's payment as retention, it records this amount as retention payable. This practice protects clients from incomplete or defective work, ensuring accountability and quality. Advance payments in construction are recorded as liabilities because they reflect unearned revenue. When Shapoorji Pallonji receives an advance, the entry debits cash and credits a liability account like advance from clients. As work progresses and revenue is earned, the liability is reduced. Crediting revenue. This ensures revenue recognition aligns with project completion, maintaining accurate financial reporting. Indian Accounting Standard 115 significantly impacts construction accounting by defining revenue recognition based on performance obligations. For Shapoorji Pallonji, revenue is recognized when control of a good or service is transferred to the client. This means performance obligations are assessed individually, and revenue is recognized over time if criteria like customer control are met. This approach ensures revenue reflects actual project progress, enhancing transparency and comparability across financial statements. Cost overruns occur when actual project costs exceed budgeted amounts, impacting profitability. In accounting, these are recognized by adjusting projected costs to complete in financial records. For Shapoorji Pallonji, this means increasing cost estimates in the work-in-progress account and revising profitability forecasts. This ensures that financial statements accurately reflect project status and profitability, allowing stakeholders to make informed decisions about project viability. ERP systems in construction accounting streamline data management by integrating all project-related financial activities. For Shapoorji Pallonji, ERP systems consolidate budgeting, procurement, payroll, and billing processes into a single platform, enhancing efficiency and accuracy. This integration reduces errors and provides real-time data analytics for decision-making, ensuring projects are managed within budget and timelines. ERP systems also facilitate compliance with accounting standards by automating report generation. International Financial Reporting Standard 16 changes lease accounting by requiring lessees to recognize most leases on the balance sheet. For Shapoorji Pallonji, this means both lease liabilities and corresponding right-of-use assets are recorded, reflecting the lease's financial impact. This treatment applies to equipment or property leases, affecting balance sheet metrics and financial ratios. Transitioning from off-balance sheet financing to on-balance sheet transparency, International Financial Reporting Standard 16 provides a clearer financial picture, crucial for investor analysis. Unbilled revenue arises from services rendered but not yet invoiced, common in ongoing construction contracts like those at Shapoorji Pallonji. It's recorded as a debit to an unbilled receivables asset account and a credit to revenue, reflecting work performed. This ensures revenue recognition aligns with project progress, providing a true financial snapshot. Accurately tracking unbilled revenue is critical for cash flow management and contractual compliance. Construction companies like Shapoorji Pallonji face cash flow challenges due to long billing cycles and upfront project costs. Managing these requires precise cash flow forecasting and stringent contract terms. Solutions include negotiating favorable payment schedules, optimizing inventory levels, and using financing options like project loans. Effective cash management ensures liquidity and project continuity, preventing delays and financial strain. The cost-to-cost method determines revenue based on incurred costs compared to total estimated costs. For Shapoorji Pallonji, if $2 million of a $10 million project is spent and total costs are $5 million, 40% of revenue is recognized. This method reflects actual project progress, aligning financial reporting with on-ground realities. It offers a realistic view of financial standings and aids in performance evaluations under Indian Accounting Standard 115. Understanding the business and processes of a construction company like Shapoorji Pallonji involves mastering their business model, which includes managing large-scale contracts over extended periods. Key to this is an effective bidding process, meticulous project management across phases, and stringent cost control to maximize profitability. Revenue primarily comes from contracts, with additional sources like change orders. Emphasizing risk management, cultivating client relationships, and integrating sustainability practices are critical for maintaining competitive advantage and ensuring future project opportunities. In construction accounting, revenue recognition often utilizes the percentage of completion method to accurately reflect project progress. Work-in-progress entries track this completion, essential for budgeting and financing. Cost allocation ensures both direct and indirect expenses are accurately assigned to projects, while progress billing ensures cash flow aligns with work accomplished. Retainage is crucial as it impacts cash flow until project completion. Understanding overhead absorption, financial reporting, and tax considerations ensures comprehensive financial management for sustainable operations. Preparing for interviews in construction accounting involves articulating revenue recognition methods like percentage of completion and understanding key financial metrics. Showcase your knowledge in managing construction-specific risks and the use of technology, such as ERP systems, for efficient project management. Demonstrating familiarity with industry regulations and tax codes is crucial, as is highlighting strategies for cost control and effective client communication. Lastly, emphasize the importance of sustainability, including green building certifications in modern construction practices. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos.